I'm looking at a chart of the euro and it's back in time. I'm going to walk you through a really great strategy that I use a lot to trade the euro when the euro is in a certain type of pattern. I'm going to walk you through a couple of these patterns that are very, very powerful. And I'm going to show you and walk you through a very powerful strategy that's very unique to options traders. People who actually buy the euro or trade currency without options actually can't take advantage of this strategy, because you need to be able to buy both the call and the put option at the same time, and then make these specific adjustments, which I'm going to walk you through right now, when certain things happen on the stock. Now, I'm using what's called an exchange traded fund, an ETF. Now, there's lots of different ETFs. You may need to do a bit of research on Google to learn more about what ETFs are, but it's a great way that I use that allows me to trade currencies without actually having to go into the forex market to trade currencies. And as you know, I like to do and use and leverage options for my particular trades. Now, I want you to look at this particular chart that you can see on the screen. I've gone back in time to the 8th of October 2015, and I'm going to walk you through a couple of my trades on the euro. And the other thing I want to mention here is that you don't have to have a lot of strategies that you need to trade. Pick a couple of strategies that you're comfortable with, that you find easy, and just use that, 1 to 2 or 1 to 3 strategies over and over again on the stocks that work best using those particular strategies, right? This particular strategy is one of my favorites, and it works brilliantly on any stock or any exchange traded fund that follows similar price patterns that I'm going to walk you through now. Now, notice here that I've got a line up the top here at 112, which is a line that is resistance. You can see that every time the euros come to that level, it sort of bounced back down. Of course, a few times it's gone above that, but generally you can clearly see that 112 is clearly a level of resistance. Now notice here what's going on here between August and November or October, which is where I'm at the moment, where I've drawn this diagonal trend line. Now notice what you can see here. The stock, in this case the ETF, the instrument is making higher lows. Each one of these bars is a particular low of that trading day. And you can see as we are moving up in price, these lows are higher, right? And that gives us a bit of a upwards trend. Now look at what's going on. The stock, when it's in this sort of triangular pattern, there's a bit of tension that's building up. The stock's trying to get and break through this level of resistance, right? And every time it gets there, sellers come on board and dump the ETF, and then it brings the stock, or in this case the ETF, back down. And as it gets down, buyers jump in and they try to buy. So there's a bit of a struggle here between buyers and sellers. But at some point, as you get closer and closer, and as this range gets tighter and tighter, and the trading days become smaller and smaller, so those ranges become tighter, it's going to break out in one direction or the other. It's either going to break up to the upside, okay, or it's going to break down to the downside. Now, we don't know which way it's going to go until it actually happens. And the way that we have a confirming indication of it's actually happened, either down or to the upside, is if you get a close either above this top resistance area and then followed by a second close, right? Or you get a close below this trend line followed by a second lower close. Okay, now I'm going to show you exactly how it looks so you won't be confused. and then I'm going to show you exactly what type of options to purchase to take advantage of this type of strategy. Now, I'm only looking for, when I do place these trades, I'm only looking for a 50% return on investment in a few weeks, okay? Not a bad return, but it's not that 100% return on investment that I normally would expect for my options trading, okay? In my experience, a 50% return on investment with this strategy actually works really well. Now, sometimes I might close my position when I achieve that 50% return on investment, or sometimes I might adjust my position and continue to trade the position in my favor. So I'm going to walk you through a couple of different scenarios, and they're going to be real trades, real case studies where I have made adjustments and things like that, so you can really learn how this strategy really works in real time. Okay, so the first thing when you start to actually see this type of pattern where you have some type of resistance and you have a bit of a trend line that's coming up towards that resistance and a bit of a triangle pattern, then you need to go into your options chain and you need to go and look at options that are going to give you at least somewhere between 60 and 90 days to options expiry. Okay, so remember the date I'm looking at the moment is the 8th of October 2015. So if we're in October, then you want to look for somewhere around about the December options expiries. Okay, so I've got the options chain up here that were from back in December of 2015. Here's the expiry date here. You can see they have roughly 70 days to options expiry. Now what you want to do is you want to buy both the call option and the put option for the same expiry. And I'm going to tell you exactly which ones to look at. You need to have on your options chain the delta of the option. Most options chain do have the delta. On my platform, the delta is shown here. So what you need to do, for the call that you're going to purchase, you need to scroll down and you need to buy a call that has a delta of somewhere between 35 and 40. Okay, so if we scroll down, you can see the delta is getting lower and lower and lower, and here's a delta of 39, and here's a delta of 48. So the delta that's between 35 and 40 is this 112 call. Okay, now the other thing you also need to just remember when you're doing this, sometimes you may not find a delta that's between 35 and 40. Okay, it's just the way that the options are constructed. You just need to make sure that you don't go more than 2 strikes away from where the current price of the stock is. So the current price of this ETF is 110.52. The next strike is 111, and the second strike away from that out of the money is 112. Okay, you want to stay within 2 strikes of the actual price of the instrument. Okay, so in this case we're going to go and buy one of these 112 calls, and then you also need to buy the equivalent put option with the same rules. So my puts are actually a little bit further down and they have a negative delta. So in this case I need to get a put option with a negative delta of between 35 and 40. So if I scroll down, here's the delta column. Okay, so keep an eye on that. You'll see the delta is getting bigger and bigger, and when it gets to 35 to 40, I'll stop. So here we go. Here's the delta between 35 and 40, and it's also within 2 strikes of the actual current price of the instrument. Okay, so I'm going to buy one of those as well. Okay, so now if I look at the risk graph, now this risk graph shows you all of my future moves because this is the real case study. I've gone back in time to show you how I traded this particular instrument with some of these patterns so that you can get a good understanding. And it's a great lesson for you on how this strategy actually works. So ignore these future dates. We'll come to those as we progress through this case study, and we'll look at the stock chart and we'll come back and do the various adjustments that we need to do on the actual risk graph to understand how this strategy works. So what I've done here is I've bought the 112 call for $125, and I've bought the 109 put $434 on this date, which was the 8th of October. Now, if I bought one each of those, it was around about $250. And so to have it so that the position's in line with my own risk tolerance, I bought 4 contracts for a total investment of around about $1,000. Okay. Now, if I scroll down to show you what the risk graph looks like, it looks like this, where I can basically profit if the stock, in this case the ETF, goes up. Okay, this is the stock price here on the left, and I can also profit if the ETF goes down. And the reason for that is because I've purchased both a call option and a put option. A call option profits as the stock moves up, okay, generally, and a put option generally profits as the stock or the ETF goes down in price. Okay, now obviously if the instrument doesn't move, then you're going to lose a bit of money, because in this case you can see the instrument has to move in one direction or the other for this position to actually make money. And how much does it have to move? Well, we just need to move down and look at the calculation. This particular option or this position, if it's to move up, it needs to move up by at least 5.8%. Okay, close to 117 for this position to double in value, meaning a 100% return in investment, or it needs to go down by 6% to close to around about 104. Okay, for this position to benefit to the downside. Now, the way that this strategy works, what we're going to do is we're going to take off either the call or the put once we get confirmation on the direction of this particular instrument. Okay, so for example, if this ETF, if euro goes above this resistance level, okay, and then on the next day it closes even higher, well, then I'm going to sell my puts, and therefore I'll only be left with my call options, okay? Because with that particular pattern where I'm going to get 2 higher closes above that resistance level, it's confirmation to me that the stock's going to move higher, and therefore I don't have to have my put options in place, because I'm no longer expecting the stock to actually decline, okay? When I say stock, I'm referring to the euro in this case, okay? The exchange traded fund, okay? So don't get confused. However, if the euro breaks down, so if I get a close below this trend line followed by another close below the previous day's close the next day, well, then I'm going to take the calls off. Okay, I'm going to sell the calls that I originally bought and simply hold on to the puts that I have, because in this case I've received confirmation that the euro is going to continue declining, and therefore I don't need to have those call options anymore. Okay, now obviously I could be wrong. Okay, even though I may get confirmation, I still could be wrong. Okay, I'm not some sort of, nobody knows what the euro is going to do. We have these indicators, we have our formulas, we have our own analysis and put together a prognosis, but of course we could be wrong. So even though we may get 2 closes below the current trend line or 2 closes above the resistance level, and we're going to expect the stock to go in a certain direction and say to ourselves we've now got confirmation, we could still be wrong. Okay, so the way that I'm going to manage this trade is that I'm going to allow myself to risk no more than 50% of my total entry cost, which is $500. Okay, so if I've invested $1,000, then I'm going to let this trade remain on so long as I don't lose any more than $500. Okay, or I make my expected return on investment of around 50%. Okay, so I'm going to push forward a couple of days until we get to the next reckoning point, which is when the euro either closes above that resistance level or closes below this trend line. Okay, because then we need to do the next step. So you can see it's simply trading within that little range Okay, so there's the first close above this resistance level. Okay, and now you can see it's come back down. So what if we were to expect this to go higher? What we would have wanted to see was another close the next day above this close here, okay, somewhere up here. Now clearly that didn't occur. The stock's gone back within this tight range, so we're continuing at the moment. We have no idea. We've received no confirmation of where this particular instrument is heading. So I'm going to continue moving forward. You can see it's still trading within its current tight range. Now, you can see these bars are getting smaller and smaller. Tension is building up as this happens, okay? The stock doesn't, this instrument, the buyers and sellers are really fighting hard to take control. So at some point, either the buyers are going to win and the stock's going to, go higher, or the euro is the sellers are going to win and the euro is going to continue going lower, okay? And that's what we need to wait for. So look at that massive move down, right? All the way from 111 straight down to 109. Now, at this point in time, we've still got open a call option and a put option, okay? We haven't made any changes to our current position. Let me actually move the trade to this current position, which is the 22nd of October. So a lot of time's actually gone by here. And so let me move up to the 22nd of October on my platform here. 22nd, here we go. And the stock, or the euro in this case, is trading at around 108.9. And let's just take a look at where our position is. What's the status of our position? You can see that we're only down by about $12. So we haven't made any money, right? We haven't made any money, even though this is a massive move down. Now, you're probably thinking, well, why haven't we made any money? I'm holding some put options, right? Put options are supposed to profit as an instrument moves down. Well, that's absolutely correct. But remember, we also have a call option, okay? So whatever gains we have made with our put options, we've lost money because those call options that we hold have decayed. They've lost value because the stock's moved down, right? So the options work against each other if the movement in the stock is, as the stock's moving. And that's why we need to take one of these off. We need to exit either the call option or the put option once we have confirmation of which way this instrument is headed, okay? We start off with both because we don't know which direction this instrument is going to go. But once our indicators confirm that it's either going up or down, well, then we can take away the one that we don't need, okay? Now, I'll show you that in a moment when we have something to work with. So right now, if we are going to have a prognosis that the euro is going to continue going lower, well, we need to see right on the next day a close below this current close, okay? This current close is 108.9. Now, I'll show you, and I'll talk in a moment about exactly how I manage this trade. So I'm going to move over to the next day. So there we go. Now we have clearly two consecutive closes below each other and also under this particular trend line. So this, with my particular strategy, the rules of this strategy are that this is confirmation that the euro is headed lower. Of course, nothing's guaranteed. We could be wrong. The euro the next day could come straight back up, completely proving us wrong. But this is the system, okay? This is the strategy. The rules of the strategy are that once we get to closes, to consecutive lower closes underneath that trend line, we have a breakout to the downside. And now what we need to do is we actually need to sell our call options so that they don't continue holding us back and we don't continue to lose money on those calls, and we simply benefit with the put options if our prognosis is correct and the euro continues to fall, okay? Remembering that I'm only looking for a 50% return on investment for our position. So if position cost us $1,000, then I'm only looking to generate $500 of profit for this position. As soon as I generate my $500, then I'm either going to make an adjustment to lock in some of that profit, or the majority of that profit, or I'm going to simply close the trade and look for the next opportunity. Okay. Now, the way that I actually automate this is when I get a day like this where I've got a clear breakout, then I put into my trading platform that I want to basically sell my open calls that I have already. Okay, remember that we've bought 4 calls. I put into the system that I want to sell my 4 calls if in the last 15 minutes of trading, the price of the stock is below this previous day's close, which is 108.9. Okay, because here's the thing. If, for example, you didn't do that, so let's say the last 2 days this occurred, well, then you'll have to wait for the next trading day, which is that third day, and you'll have to put your order in at the open of that third day. Okay, that's how you would have to do it. If you were to wait for the day, for the market to close before you determine that the euro closed lower than the previous day's close. Okay, for me, I simply shift my definition of when the market closes. My definition of when the market closes is 15 minutes before the actual market close. The reason I do that is so that I can actually get into this position just before the market closes, so that I don't have to wait for the third day and get in on the third day, which would have to be when the market then reopens. You have to then put an order in. Okay, so therefore, if we now move to this date on our platform, which is the 23rd of October, you'll see on the 23rd of October, I have sold my calls for $55 each. So I'm just going to move to the 23rd of October and let's see. So right now, we're basically 12, let's see, what date is this? So we've got to move up by 1 day, 23rd of October. Okay. So let's move forward by 1 day, 23rd of October, at which point I have sold the call options, and now I only have 4 put options. Okay, so by selling these 4 call options, I've brought in some money. Okay, and therefore my current net is an open profit of $224. Okay. Now, if we look at the risk graph, we only have put options, and you can see that we only have put options because we're only profiting as the stock price moves down. Okay, if the stock price goes up, we don't make that profit anymore. Okay, so we've only got a bearish position open, right? We're expecting the stock to move down, so we only benefit if the stock continues to move down. If we go down to our table of when this stock actually doubles, you can see that it only has to move by just a bit over 2.5%, okay, down to around about 105 for this position to double in value. Okay, 105 is not very far from where the current price of the stock is. It's very close to that previous level of support. Okay. So at this point, if we do get down to this level, then it's a good position. That's a good place to actually close the position, right? Or make some sort of adjustment to lock in some of those profits. Okay. So I'm going to continue moving this trade forward so that we can start to understand what some of these decision points are going to be. So you can see there's another big move down, massive move down on the 28th of October, where we're closing at around close to 107. So let's move to the 28th of October and let's look at the status of the position. '28th of October. So here we go. Just waiting for that to light up. So you can see that the position is in profit by around $388. Now, this is open profit, all right? None of this has been locked in. So at any point, if the euro starts to move up again, well, then this open profit will start to decay, okay? So that's something that we need to be aware of, that at any point, any of this profit could be wiped out. And in fact, if the euro skyrockets higher, then this open profit actually could in fact turn into a losing trade. Okay, it's all at risk at the moment. So let's continue and monitor this trade. So you can see the next 2 days, the euro started to move back up. Okay, let's look at our particular position at this point in time, which is the 30th of October, right? So we had a massive move down, and the next couple of days, the euro started to move back up a bit. It didn't move up a lot, but it did move up a bit. So 30th of October, let's just move our trade to that date, and let's see if that had any negative impact on our position, or how much of an impact did it have on our position is probably a more accurate question, because we know that would have had some impact because the stock moved in the opposite direction of where we're expecting it to go. You can see that half of our profit just got wiped out just in 2 days, okay? So we're now back at $172 of profit, right? If it continues to move up over the next couple of days, this trade that's in profit right now could in fact go into a losing trade, right? So you've got to be really careful and continue to monitor your positions, okay? So let's continue to move forward in this trade. You can see the euro continuing to move down, right? So this is now the 4th of November. Just going to move forward by the 4th of November. So it should be there. And let's look at the status of our position. This is why it's so important to have your management plan in place, so that you're not having to make decisions on how you're going to manage the trade with all your emotions flying high as the underlying instrument is moving up and down. Okay, our management plan has already dictated for us that we are going to risk up to $500, okay, or we're going to make a return of 50% ROI. Now you can see that on the 4th of November, which is where we are at, that we have in fact reached a profit of 564, okay, which is a 50% return on investment, okay? Now, I'm not sure why, maybe I didn't review this position on this day, but I can see that I didn't make any adjustments until the 6th of November. So I should have actually made it on this day, but as I've said many times before, I don't look at the markets every day. So it could have been that I didn't look at this position until the next couple of days, which is when I actually made my adjustment, as I can see here on my activity records here. So I'm going to continue and move forward another couple of days. Okay, so the stock's actually a bit lower. So we can see here that this is the 6th of November. I'm going to fast forward now to the 6th of November. And then I'm going to look at the status of the position. 6th of November is actually up here. So if we scroll down, we have an open profit of $864, and it's at this point that I actually sold 3 of the 4 put options that I had, okay, leaving me with 1 open put option. So I've locked in a profit of $444, which is almost 50% of my entry cost. My entry cost was around about $1,000. Okay. Now, no matter what happens with this particular trade, whether the euro goes up or down, I've locked in this profit. Okay. This profit cannot be taken away from me because I had an open position of 4 put options. I've now just sold 3 of them, which leaves me with 1 open put option, which will continue to increase my profits as the euro continues to fall. Okay, you can see that I have an open profit of 864, so I'm still leaving on the table a bit, roughly around about $400 of profit. Okay, which is that current put option that I still haven't sold. If I sold that right now, then my total profit would be 864 and I could close this trade and walk away. Okay, now I'll continue to move forward to see at what point I actually closed the position. Now the euro right now is below that previous level of support. Okay, so based on this chart, I can see that the next sort of level of support is around this 104 or 103 level. Okay, so that's where the euro could be headed, and that's probably my thinking at that point in time. Okay, so let's continue. Let's monitor how this position progresses. So still sort of hovering around that 105. You can see here it's actually starting to go up a bit. Just sort of hovering around that 105. Now starting to move back down towards that 104. Okay. So let's have a look at our position in this point in time, which is the 18th of November. So let's just set the calendar to 18th of November. Remembering that we had an open profit of 864 and a locked in profit of 444. So if we scroll down, let's look at the numbers. Now you can see that locked in profit won't change because that's achieved by selling those put options earlier. So that'll remain the same. But the open profit is now $934 because the euro has moved down a bit more. Okay. So we'll continue to monitor this. You can see now it's sort of just hovering around that 104. And it's now the 25th of November, so it's pretty much at the same level as what it was a couple of days ago. And now it's the 27th, well, it's actually the 30th here. So I'll just go back a day because that's the Friday there. So the end of the week, and the euro is very close to this low support level of 103, and this 27th of November is the Friday, which is the end of the week. So when that's occurred, I've actually exited this position, as can be seen here that I've sold that last put option that I had open. So I'm going to just move to the 27th of November, and the other reason I exited this particular position on that date as well is because I'm running out of time. Okay, if you look at my days remaining to options expiry, it's only 21. So we're now within that last 30 days to options expiry, which I don't like to be within. Even though that at this point in time, I'm holding a 109 put, and the euro at this point in time is close to 104. So the put that I have is right up here, okay, which is deep in the money. Okay, so I have the right to sell euros at 109 because I hold a 109 put, and the euro is right now at around or under 104. Okay, so when you have deep in the money options, then time decay is not much of a factor. Okay, so on this particular day, I've now closed this position and I've been able to get almost a 100% return on investment. Okay, a dollar profit of $977 with an investment of $1,000. Okay, so I'm going to continue and talk about another pattern. Okay, so remember this pattern. You've got a bit of resistance, a flat sort of horizontal resistance level, and you're making higher lows. Okay, higher lows, and then at some point you're getting a very tight range, and it's at that point when you're getting a very tight range that you want to expect some sort of breakout, and you want to then prepare and position yourself to take advantage of that breakout. And then when you get some sort of confirmation that the stock or the instrument has broken out in a particular direction, then you want to make sure that you take off the position that's not going to benefit, okay, with that move towards the direction that you're now expecting the instrument to move towards, okay? So in our case, once we got confirmation that the euro is going to start to move lower, then we took off our call options. We sold our call options because they would not benefit and they would actually lose money as we continue to go lower in the euro, okay? So that's the reasoning behind why we actually sold those call options. And that's also the reason why we buy both the call option and the put option at the start of this trade, because we don't know which direction the instrument is going to go until we get some type of confirmation. So now I want to talk about another pattern, and I'm just going to fast forward until this pattern develops, and then I'm going to talk about it, okay? Now, this is basically where you start to build a bit more tension, where you get higher lows but lower highs, okay? So if you look at the two diagonal lines that I've drawn, look at how tight this range is, okay? We've got higher lows, right, as the stock, in this case the euro, is moving up, but we've got lower highs. These highs are actually becoming lower and lower and lower, and you're getting this tight triangle formation, okay? You're getting this triangle formation, and this is another breakout pattern, okay? Now, we don't know which way it's going to break out. We need to wait for either two closes above the lower highs or two closes below the lower lows, okay? So either we're going to have a breakout to the upside or a breakout to the downside. So we do the same thing here. We have the 22nd of January, okay? On our options chain, let me go to the 22nd of January on my platform here. Okay, so we do the same thing. We go and look at our options chain, and we find a option with at least 60 to 90 days options expiry, okay? And we find a call option that has somewhere between 35 and 40 deltas, and a put option that has somewhere between negative 35 and negative 40 deltas. In this case, we were in January and we decided to go with April options. If I look at how many days to expiry that was, it was 84 days to options expiry, okay? And we went with the 107 call and the 104 put, okay? And we had to pay around $1,100 for that. Now, and so I bought, so that's because I bought 4 contracts, so roughly around about $250, $260, okay? Now, if we look at the risk graph again, it's the same risk graph that we started off before, where we benefit as the stock moves up and we benefit as the stock moves down, or in this case, the euro is what we're talking about. If we look at the numbers, the stock needs to move up around about 6.5% for us to profit, or down by around about 6.5%, okay? Now, we need to wait for the position to make some sort of confirmation to confirm the direction that it's going to be traveling in for us to then take away one of those options. So let's move forward. Let me also just see what we did here. So what's the date today? It is the 22nd of January. So let's wait for a confirmation. Then we'll look at the options. So you can see it basically traded within, look at how small those bars are becoming. Okay, so as you get closer to that triangle, it's more imminent, it's more higher probability that a breakout's going to occur. Okay, nothing guaranteed, of course, but we're just playing with probabilities. So you can see now we have a close above that triangle, and the close on that particular day is 106.59, and we have another close higher at 107.06 next day. Okay, that's what you want to look for. You want to look for two consecutive higher closes, okay, outside of that triangle. So what's the date here? The date here is 28th of January. So what do you think we would do on the 28th of January? All right, have a think about it. Which way are we saying the euro is headed based on this movement? And your answer should be that it's headed to the upside. So if it's headed to the upside, we have a call option and we have a put option. Which one of these which one are we not interested in anymore? Well, if we are now predicting that the euro is going to go higher, then we're not interested in our put options, okay? We simply want to keep on our call options because they are the ones that are going to increase in value as the euro moves higher. So on the 28th of January, we want to sell our put options, okay? And simply hold on to our call options, okay? So I'm going to move to our date here of the 28th of January. And now we should have sold puts. So you can see on the 28th of January, I've sold 4 of the puts that I had, and I sold them at $81 each. Okay. Now our position isn't doing much. I'm in profit by about $16. Okay. So we haven't really done much at all, and that's because the stock hasn't moved anywhere. We're still pretty close to where we were, okay? And obviously, because it's moved up a little bit, we took a bit of a loss on the put options that we had because they only profit as the stock moves down and they actually lose money if the stock goes in the opposite direction, okay? So if I now look at the risk graph, you'll see that we have a risk graph that is basically profiting as the stock moves up. You can see that as the stock moves up, the position actually profits. Okay, it's moving to the right hand side. Okay, profit is on the bottom axis here. So as the stock moves up, or in this case, we're talking about the euro, as the euro moves up, then our profits actually increase. Okay, so we now need to just continue and see how this trade works out. So I'm going to continue moving this forward. You can see it's actually back. It's gone straight back into its range. Okay. And now it's come back up. So there you go. You've got a massive move to the upside. Okay. So this is why I love this pattern. You generally get a nice breakout in one direction or the other. Look at the one previously. Okay, a big bang to the downside, a big breakout. Now this one to the upside, bang to the upside. Okay, and you don't know which way it's going to move, so therefore you need to have a way to be able to trade in any direction, and that is the beauty of options. You can buy a call and a put option to potentially benefit from any movement. Okay, people who have to buy the actual currency can't do this. Right? You can only do this strategy with options. That's the power of this strategy. So I'm going to fast forward to this day, which is the 3rd of February. And before I do that, I'm going to show you that this position doubles in value with a small 3.5% movement in the underlying instrument. Okay. The euro only needs to be up at 110.67 for this position to double in value. So let's have a look at this date, which is the 3rd of February. Okay, so I'm going to move my calendar up. 3rd of February. Let's see, where is that? Let's go to February. And it is the 3rd. So just waiting for that to load up. Okay, and now you can see that we're almost at that 50% return on investment. Remember, we invested around about $1,100. Okay, so I like to make an adjustment or close the position when I reach that 50% return on investment. Okay, so let's continue watching what happens with the euro. So you can see another nice move to the upside. Okay, so this is the 4th of February. Now at this point I can see that I did do some sort of adjustment here, so I'm going to move to the 4th of February and I'm going to talk about what I actually did. Okay, so the 4th of February is Thursday. Now at this point my profit level would have been somewhere close to that 50% of my entry cost. Okay, you can see the open profit is $652. Okay, which is around about that 50% because we invested around about $1,100 to get into this position. So what I've done in this case is I've sold 3 of the 4 call options that I had open, and I've locked in a profit of close to $300. Okay, no matter what happens with the euro now, this $300 that I've got is locked in. Okay, I will always walk away with this minimum profit. Okay, but I'm leaving on the table an open profit of $652. Now that's because I still have that call option open in the market. Okay, so let's continue to monitor this so that I can walk you through when I actually close this. Now you can see it's sort of hovering around that 109, okay, 1010, okay, up around here. And now we're right up here on 111, okay, and very close to the previous level of resistance, which is 112. Let's have a look at the position at the 9th of February. Just waiting for that to load. So let's look at the status of what the position looks like. What's the performance of the position on this day, which is the 9th of February. So you can see that I have an open profit of $724, okay? So I'm now waiting until I can sort of achieve that 100% return on investment after this adjustment, or I'm waiting for us to get to that resistance level of 112, okay? That's my sort of thinking at this point in time, okay? So let's continue to see what happens. You can see that getting a bit of volatility. This is a fairly long range day, okay? We had a low here of 109 and a high of 111 almost, okay? And we're still getting close to that. You know, the stock is sort of bouncing around that 111, the previous high, and it's sort of jumping around now. You can see that now, okay, we're at 109, which is that previous support level, okay? Now, basically, I don't want to see, so because you can see here that the stock has sort of held its support at 109 previously, I don't want to see the euro now get a lower close below 109. If I see that, I want to basically exit this position. Okay, I've taken a bit of heat here, so some of my profits actually come down. So I'm going to move up to one more day, and you can see that I've got a lower close. Yesterday's close was 108.97. Now I've got a close of 108.87. Okay, so I've got 2 closes below that 109. I'm going to exit this position. So this is the 17th of February. You can see on the 17th of February, I sold, okay, that final call option that I was holding on to. Okay, I lost a bit of profit because I held on to that, took a bit of heat, but that's the way the game goes. Okay, so the 17th of February, okay, because you need to know that you can't get out at the peaks. You need to give the stock a little bit of room to move around. You don't know that's a top. right? So you got to have a level on the chart where you're going to say, well, okay, looks like now there's weakness. Now it's time to get out. Okay. And for me, I took a bit of heat, a couple of days where the euro fell down a bit, and I identified 109 to be a key level. I got two closes below that 109, and therefore I closed my position. Let's now look at the performance of the position after its close. So you can see I was only able to lock in that 50%. Okay, I invested about $1,100, got as high as $700-800 in profit, but then as the market sort of came back down, I gave up some of that profit, and at the end of the trade, I was only able to lock in that 50-60%. Still a great trade. Okay, 60% return on investment in just a couple of weeks, not bad at all. Okay, no one's going to argue with that. Okay, so let's continue moving on, and let me talk to you about the next pattern that I identified. So you've seen this pattern already. Let me fast forward a little bit. You can see you've already recognized, you should be able to recognize this pattern because it was the first pattern. We have horizontal resistance level and we have higher lows, okay, where we have this diagonal line where we can see there's a bit of tension building up. Okay, so you can see the stock's hovering around that 111. So let me move to this date. What's this date here? The 5th of April. Let's go to the 5th of April. Okay, same scenario. We on April need to find options that give us at least 60 to 90 days before they expire. So we went with June options. Okay, we need to buy a call option with a delta of somewhere between 35 and 40, and we need to buy a put option with a delta of somewhere between minus 35 and minus 40. Okay, so if we go down and see when these options expire, we have about 73 days before these options expire. The position cost us $1,000 roughly. So this position on a single contract would have been roughly around about $250. Okay. If we scroll down a bit, we can see that the stock, in this case the euro, needs to move up by 6% for this position to double, or below low needs to go below its current level by around about 5.7% for this position to double on the way down. Okay, so remember, we're waiting for some sort of breakout, either to the upside or to the downside. Okay, you can clearly see the risk graph is going to profit to the upside or profit to the downside, and we'll actually lose money if the stock doesn't move at all. Okay. So let's continue to monitor what goes on. So the stock's still just hovering around that 111 mark. Okay. Hasn't really done much at all. Now we get our first sort of breakout to the downside. And at this point in time, I would have entered into my trading platform that on the next day, if the stock closes below the current day's close of 110.22, then sell my open calls because I'm predicting the stock to go down, right? That's what I would have entered into my brokerage platform. So you can see the next day, the stock in fact did close below that previous day's close. So now on the 14th of April, I would have sold my open calls. So let's go and look at the 14th of April. And you can see on the 14th of April, I sold 4 of these call options that I had. Okay. So at that point in time, our position was down by around about $56. Okay. Because we took some heat by the stock moving down a bit on those call options. And of course, almost 20 days has gone by, so some of those options would have decayed in value as well. Okay. So we can see if I scroll down and look at the risk graph, we only have some put options open because our position benefits as the stock moves down in price. Okay. So let's continue to see what's going on. So you can see that the stock's gone back above its previous resistance level, right? Now let's move to this date. It's the 19th of April, and let's look at the status of our position. So in this case, even though we got some sort of confirmation and we took off our calls, the stock actually started to go back up in the opposite direction, even though our system was telling us that now the euro is going to continue to go lower. As I said, we could be wrong. And in this case, you can see we have an open loss of $300. Now remember that the way we are managing this trade is that we are risking, as I said at the start of the video, no more than 50% of our entry, okay? So we hold on to this position until we reach our risk tolerance level, which for me is 50% of my investment, okay? The amount invested for this position was around about $1,000. So I'm willing to lose up to $500 before I say to myself I'm wrong and I want to cut my losses, okay? So if we continue to monitor this, let's see what happens. You can see it's starting to come back down again. Going back up, so sort of chopping around that 110, 111. Come back down now, so maybe we're right. Maybe it is starting to pull away and break down. Let's look at 22nd of April. So a lot of time has gone by and this position hasn't really done much. What date did we need to look at? It was the 22nd of April. 22nd of April. The time is also working against us. We have both an open, when we start to trade, an open call option and an open put option. Those two options will work against us if time's going by and the stock's not doing anything. Okay? Now you can see we're only down by $72. Okay, so some of that loss has come back because the stock has started to move back towards the direction that we want it to move, which is to the downside. Okay, but a lot of time's gone by. Okay, so let's continue to see what's going on. You can see the stock sort of just still hovering around at 110, 111, not really doing much at all. Okay, let's continue. So right now, a lot of time has just gone by. Let's have a look, 28th of April, and let's just look at the status of our position. So 28th of April. You can see that even though we've got a bit of a breakout out of that triangle, the stock's still just hovering around at 110, 111. Okay. So you can see time is just going away. So 20, 25 days have gone by. And we're back at our $300 loss. Okay. So not really going in our favor so far. And now you can see the stock has made a fairly significant move back to the upside. Okay. And now on the 29th of April, we are probably pretty close to our $500 maximum level of loss potential, which is in accordance with our management plan. So you can see here that on the 29th of April, I was at a loss of $450, and so I decided to close out the open put option that I had and leave this position for a loss of $450. Okay, so it was a losing trade. You obviously get those as well. Let's continue on and look at the next trade. Okay, so you can see the next trade what do we have? We have, now this is the current market time. This is September 23rd, okay? Basically last Friday. You can see that we have another triangle pattern, right? So the reason I've gone through with you is to show you how I trade this type of pattern. I've shown you a couple of examples. And now the euro is in this exact same pattern right now. So what do? What's a potential trade for an educational case study that you can look at? Well, you do the same thing. You go out to the market and you find an option that expires between 60 and 90 days, and a call option that has a delta somewhere between 35 and 45, and a put option that has a delta somewhere between negative 35 and negative 45. Okay? And so one of the options that meets that criteria is the December, okay, which has 84 days to options expiry. Remember, we're looking for options that expire between 60 and 90 days. And the 111 call and the 108 put meet the delta criteria that I've mentioned for this type of strategy. Again, the price of that position for a single contract is somewhere around $200 in this case. And so that allowed me to buy 5 contracts because I like to invest around $1,000 per position. Now, if I scroll down to the risk graph, you can see we both benefit to the upside and the downside, but obviously we're going to take one of the sides off once we get some sort of confirmation. The trade only has to move up by just a bit above 5.3% for the position to double to the upside, or to the downside at 5% for the position to double in value to the downside, okay? So this is the current price of the euro, okay? So you'll have to wait for this trade to, work out or not work out over the next couple of weeks, and I'll give you an update as it's progressing. But I would expect that the euro would maybe continue to move a bit closer into this range and either move up and break above or move down and break down, okay? And then that'll be our next decision point where we'd either take off the calls or we take off the puts depending on which direction it's broken out, okay? So watch out for the next update video for the euro, in which point we will make a decision and take off the calls or take off the puts and continue to trade this, okay? Remember, as I've said, trading is very risky. You should only trade with capital that you can afford to lose. Always know your risk in any position and always understand your risk and have a trade management plan in place ready before you enter into any positions. And keep in mind that my videos are for educational purposes only.